Hey folks, another great jobs number call today. Those of you who got my email yesterday when I sent out my forecast, I said the number was going to be over 209,000. We got 222,000. I said in my email that yesterday's ADP payroll number was going to be a head fake, that the Bureau of Labor Statistics number, which we got today, was not going to be weak. Once again, I hit the number right on the button, showing that my analysis, my approach to analyzing and making a forecast on these very important data releases is far superior than anything you're going to find out there. Okay, I got the last one. And by the way, these are not calls that have been close to the forecast. These have been, these have diverged greatly from the forecast, and I called them every single time, all right, based on my analysis. I also said that treasuries were going to go down based on a stronger number. I said the dollar was going to go up based on a stronger number. I said the zombies were going to sell gold based on a stronger number, okay? And that's all happening. The only true move that you are seeing here today, and by true move, I would say one that is aligned with the fundamentals, is the Treasury selling off. That is how it should be, and we will continue to see that over a period of time. There is no question that the Treasury market is in a bear market, notwithstanding the recent rally we have seen in Treasury prices and some of the pullback we have seen in yields, although that pullback is now kind of unraveling. However, the dollar rally, I'll go on record to say this right now, the dollar rally is not sustainable. Okay, higher rates are not bullish for the dollar. I've been saying this since the beginning of the year, since before that, and I have been correct. All right, don't remember, the dollar index was up at what, 103 at the beginning of the year, and I said the rate hikes going to send it down, and a lot of you mousy boys were saying, oh no, rate hikes, bullish for dollar. Where is it now? Like 94, 95, something like that, the dollar index. So you have to sell the dollar on this rally. Same thing with the gold. Gold goes up when rates go up because higher rates, I'll repeat it again, those constitute price increases. The cost of credit is reflected in the cost of all goods and services. You could see how inflation turned around starting from 2015, December 2015, when the Fed raised rates. So let them sell the gold. It's a good opportunity here. You have, in addition to that, and I spoke about this yesterday, you have mindless producer hedging going on. Mindless hedging, I'm calling it. This is idiotic hedging to lock in a 1% return for 1 year, basically a 1-year T-bill rate. This is mindless hedging. And not only is it mindless, they have so over-hedged. There is not enough physical gold in COMEX warehouses to cover these hedges. Okay, so it's a potentially very, very explosive situation. It doesn't mean it's going to happen. I mean, you can have a barrel of gunpowder sitting there, or you know, a case of dynamite sitting there. Doesn't mean it has to go off. You need something to set it off. But I'm just saying it's a potentially hugely explosive situation. You do not have enough physical gold to cover all these hedges. Producers are way, way, way overhedged in gold, all right? And the zombies, they're selling because they think, oh, higher rates, bearish for gold. No, it's not. It's bullish, right? So that's it. That's what I'm doing right here. I'm selling dollar yen. I'm buying British pound against the dollar. Looking for a little bit more of a pullback in euro. I'll get back into that. And I got those trades on. Gold, I'm in, but if you're not in, this pullback is definitely a pullback to buy, okay? As far as the stock market is concerned, some interesting observations, I would say. I had people recently, I had one guy who said he was canceling my report yesterday, which is fine, all right? But he said that the market is become, by the way, he said he couldn't figure out my oil call, which is very, very strange because I caught every single swing in oil. We were short the oil, ran up to 47. I stayed short. I covered today 44.30, and actually I got long down here because I believe that the oil picture now has some clarity. That looks like the oil fundamentals are coming a little bit better into balance right now in terms of supply and demand. So I am long the crude down here. But he said he's quitting because he doesn't see, he's getting a little bit concerned about the market action. It's unclear. These are people moving kind of to the neutral camp. All right. Now we've seen a lot of this lately. And it's interesting because it's the first time, and he was a fashionista. This guy was a fashionista. So some of these and you know what fashionistas are. They buy stocks because it's fashionable to buy stocks. They didn't buy them last year when I was telling everyone to buy them. They didn't buy them last year, when the S&P was at 2,000. No, they bought it when it was at, up here, 2,400. So that's what I'm talking about. Seeing a little bit, doesn't mean it's widespread, a little bit of a change in the sentiment. Fashionistas, some of them anyway, turning a little bit neutral. Keep your eye on that. It could play out into a broader move here. So that's what I'm watching. Anyway, another great call on the jobs number, and see everybody later. Bye-bye.